Businesses exist in a tension between two powerful imperatives: generating profit and contributing to the public good. Profit maximization, long the dominant corporate objective, emphasizes efficiency, return on investment, and wealth creation for owners and investors. Philanthropy, by contrast, redirects corporate resources towards social, environmental, or cultural causes without expectation of direct financial return. Framing these as opposing forces is helpful for analysis, but in practice, they interact in complex and evolving ways. Profit maximization rests on several practical strengths. It provides a clear, measurable objective that aligns managers and investors, supports capital formation, and incentivizes innovation. Firms that prioritize profitability can scale, create jobs, and fund future investment. A narrow focus on short-term profit, however, can produce negative externalities, environmental damage, labor exploitation, or erosion of public trust that ultimately impair long-term value. Philanthropy addresses needs that markets and governments may neglect. Corporate giving can alleviate social problems, enhance community relations, and build goodwill that translates into customer loyalty and employee engagement. Strategic philanthropy, where giving is aligned with company capabilities and business strategy, can produce mutual benefits. A firm leverages core competencies to tackle social issues in ways that also strengthen its competitive position. Recent shifts in corporate governance reflect growing recognition that profit and purpose need not be mutually exclusive. The shareholder primacy model is being complemented by stakeholder-oriented approaches that consider employees, customers, suppliers, communities, and the environment. Legal innovations, benefit corporations, B Corp certification, and investor interest in environmental, social, and governance, ESG metrics, have expanded the ways companies can pursue blended objectives without abandoning financial discipline. Reconciling philanthropy and profit requires practical frameworks. First, distinguish between activities that directly contribute to core business objectives and those that are purely charitable. Strategic investments, such as workforce development programs that expand the talent pool or product innovations that serve underserved markets, can generate both social impact and sustainable revenue. Second, set transparent metrics for both financial performance and social outcomes so trade-offs are explicit and measurable. Third, align incentives across leadership and boards to prevent short-termism and ensure accountability for long-term value creation. Trade-offs will remain. Pure charitable giving that drains resources without strategic alignment can weaken competitiveness. Conversely, an unyielding focus on quarterly earnings can erode societal license to operate. The optimal balance depends on firm maturity, industry context, and stakeholder expectations. Startups might prioritize growth to ensure viability. Mature firms with stable margins can allocate resources towards social initiatives that reinforce brand and employee retention. Policy and institutional design also matter. Tax incentives, public-private partnerships, and regulatory standards can shape corporate behavior by lowering the cost of socially beneficial investments or by internalizing externalities. Investors increasingly demand transparency on how companies manage social risks and opportunities, making integrated reporting a practical tool. In the end, viewing philanthropy and profit as binary choices is less useful than treating them as complementary levers for sustainable value. Profit generates the resources needed to address social challenges. Purposeful action strengthens the social fabric that underpins long-term profitability. Companies that embed social impact into strategy, measure outcomes rigorously, and maintain financial discipline are best positioned to serve both shareholders and society over time.